In this chapter 1, we first examine the use of interest rate forwards to hedge the uncertainty of an interest rate reset on a floating rate loan or investment. We then explain the pricing of these instruments from a zero coupon yield curve and the determination of the forward rate itself. We then describe in detail all the mechanics and settlement conventions of a forward contract, often known as a FRA, for forward rate agreement. And we conclude by illustrating how a mispriced FRA can be arbitraged and the limitations on such arbitrage strategies. We begin with the assumption that your bank offers zero coupon deposits for periods ranging from 3 months to 5 years based on dollar LIBOR, and therefore has a liquid zero coupon yield curve we can use for our pricing exercises. Markets or issuers for which zero coupon rates do not exist per se rely on a technique known as bootstrapping, discussed in one of our other modules, for implying zero coupon rates starting with a regular yield curve for coupon-bearing debt instruments. The rates you show for 3-month and 6-month deposits based on LIBOR are 3% and 3.5% respectively. We assume these rates are exactly equal to LIBOR, so we'll make reference to the generic LIBOR going forward rather than to some bank's specific deposit rate all through this module. A depositor now approaches you today, January 1, 2009, asking what rate you would offer her for a 3-month US dollar deposit she expects to place with you in 3 months' time, i.e. from April 1, 2009 to July 1, 2009. We assume all relevant days are business days. In the vocabulary of financial markets, we would say that she is asking you for a 3-month forward, 3-month rate on LIBOR. We also denote this rate as the 3 times 6 forward rate, where the first digit indicates the number of months from now until the start of the period in question, while the second digit indicates the number of months from now until the end of that period. Note that this notation does not indicate directly the length of the period in question, which you can, however, derive by simple subtraction. Quoting your customer a forward rate requires you to undertake what is known as a no arbitrage pricing exercise. We illustrate this procedure first assuming there is no bid-offer spread. The process is summarized in the diagram which has just appeared, which assumes first that you go ahead and borrow funds for 3 months at 3% and invest them for 6 months at 3.5%. We base the calculation on one single notional US dollar, since the specific notional amount does not, in fact, alter the outcome of the calculation. it should be clear that your investment at the end of 6 months will grow to 1 plus 3.5%, the 6-month rate, times 181 over 360, using the correct day count convention, which is 1.0176, rounded to 4 decimals. It should also be clear that the money you have borrowed will grow to 1 plus 3% times 90 over 360, which is 1.0075 at the end of the first 3 months. Assuming you now borrow this amount of 1.0075 again for 3 months, so that now your investment and your borrowing will mature on the same day, you would break even if and only if the borrowing grew over the next 3 months by an amount equal to the ratio shown here of 1.0176 divided by 1.0075, which turns out to be, rounded to 4 decimals, 1.0100. Since this second period of 3 months contains 91 days exactly, you can solve for the break-even rate you could pay on this second borrowing by calculating 1.0100 minus 1 times 360 over 91, which leads to the forward rate being 3.9648%. This method is called the no arbitrage method because any other rate you quote would give your counterparties the opportunity to make a riskless profit at your expense. We will illustrate this in a moment with an exercise. One good way of thinking about the forward rate of 3.9648% is that it is the rate that would make an investor who invests for 6 months achieve exactly the same return as one who invests for 3 months and then again for 3 months at this implied forward rate. This follows from the algebra we used to derive the forward rates. More generally, we can describe the insight behind the no arbitrage argument by writing 1 plus the rate for the long period times the number of days in that long period divided by 360 is equal to 1 plus the rate for the short period times the number of days in the short period divided by 360 multiplied by 1 plus the rate for the forward period times the number of days in that period divided by 360, which simplifies to the equation for F, the forward rate, or the FRA rate that you see here. And again, as a reminder, the variables appearing in the formula are as described at the bottom of the slide. We have in fact programmed the second formula on worksheet FRA and will be asking you to use it shortly. Of course, you probably understand that you would need to use 365 in the appropriate places if the currency is one whose money market calculations are based on actual 365, such as sterling or many emerging market currencies. We have so far described the 3x6 FRA as the rate you would be prepared to pay to your customer on a deposit she places with you starting April 1st. In fact, FRA contracts work a little differently. The bank simply identifies the FRA rate in the confirmation along with the notional amount and agrees in essence that if LIBOR for the period in question turns out to be different from that rate, it will settle the FRA in such a manner as to bring the customer back to the rate quoted in the FRA. The customer has no obligation to actually place her funds with the bank itself. She can place it anywhere she likes, hopefully earning LIBOR at least, and the bank quoting the FRA will simply settle the FRA to bring the customer back to the quoted rate, all in. Note that in our illustration above, this would mean paying money to the customer under the FRA if the actual LIBOR resets below the FRA rate, but receiving money from the customer if LIBOR resets above the FRA rate. Ignoring day counts and the length of the period, if LIBOR resets 1% below the quoted rate, the bank would pay an annualized 1% to the customer, while if LIBOR resets 1% above the quoted rate, the bank would receive an annualized 1% from the customer. The end result of all this, mathematically, is to ensure that the customer has earned on her deposit an annualized rate exactly equal to the 3.9648% rate the bank had quoted. This is why a FRA is usually depicted as shown in this diagram, with the customer receiving LIBOR from the deposit she has placed, and in effect paying that LIBOR over to the bank under the FRA, receiving the FRA rate of 3.9648% from the bank, and earning all in the FRA rate as appears obvious from this diagram. We now illustrate all this with an example in which the actual LIBOR rate at the beginning of April has reset at 3.75%, and in which we assume that the client's deposit is for $100. The interest your client would earn on a deposit yielding 3.75% during the period April 1 to June 30 comes to $100 times the 3.75% times 91 days for that period divided by 360 equals $0.9479. Under the FRA itself, you, the bank, would also pay to your client an amount equal to $100 times the difference appearing in the parentheses here between the FRA rate and the 3.75 at which LIBOR settled, adjusted for the day count, which gives the client an additional $0.0543. The sum of the two amounts in question gives your customer a total of 1.0022, which is exactly equivalent to an annualized 3.9648% for a 91-day period. Please click the pause button and confirm this statement to your satisfaction. There is one last important detail to note about the settlement of the FRA. The bank and its customer will know the level of LIBOR for the second period at the beginning of April. In fact, 2 business days before the beginning of April. And so we'll be able to calculate the amount of the net settlement on that same day. The bank could hold on to those funds and pay them to its customer at the end of the period, which would have the advantage of matching the day on which the customer receives the interest under the deposit. Or the bank could simply pay some discounted amount up front to the customer. The FRA market has adopted the latter convention since it reduces the total amount of counterparty and operational risk in the system. So the net payment the bank makes equals the gross amount of 0.0543 discounted for 91 days at the current LIBOR rate of 3.75%, as shown in this formula, and this equals $0.0538. Assuming the customer can now invest this slightly smaller amount at exactly 375 for the next 91 days, the outcome is the same exactly under the 2 alternatives. We can therefore write the general formula for the settlement payment under a FRA as follows. The settlement payment equals the notional times the difference between the 2 rates, adjusted for the day count, and discounted at the settlement rate, adjusted again for the day count. To complete our discussion of FRAs, we provide here the full set of notations for different contracts starting on different dates. Thus, as you can see, a whole series of FRA contracts for 3-month LIBOR exist, the first of which appears in the second row of this table as the 3x6, relating to the period that starts in 3 months and ends in 6 months, all measured from today. Another contract would start in 6 months, end in 9 months from today, and would be denoted 6 times 9 FRA. The contract for the period after that is the 9x12 FRA, and so on. And this process continues, for example, into year 2, where for the period starting in 21 months and ending in 24 months, we would speak of the 21 times 24 FRA. And by the same token, this table shows FRAs for 6-month LIBOR, with the 6 times 12 FRA covering the period that starts in 6 months and ends in 12 months, etc., until in, for example, year 5, if we are trying to hedge a LIBOR reset for the last 6 months of that year, we would speak of the 54 times 60 FRA, since that period starts in 54 months and ends in 60 months. Pricing for any of these contracts follows the exact same principles that we have seen. So, for example, to calculate the 6 times 12 FRA rate, you would need the 6-month LIBOR, which is 3.5%, as we know, and the 12-month LIBOR, which we will assume is 4%. Applying the formula provided above, we can set 1 plus 4% times, note carefully here, 365 over 360, a fraction that may appear strange but correctly reflects the actual over 360 US dollar LIBOR convention. And this amount on the left-hand side must equal 1 plus the interest rate for the first 6 months with the appropriate day count adjustment times 1 plus the forward rate also for 6 months with the correct day count convention. And this in turn leads to a 6 by 12 FRA rate equal to 4.41%. You should now please open worksheet FRA and confirm this calculation to your satisfaction. We illustrate finally how an arbitrageur could make a riskless profit if the bank quoted him a wrong FRA rate, say for the 6-month period. We also introduce bid-offer spread shortly and illustrate the more limited arbitrage opportunities that exist in the real world. Take the case of a dealer who quotes 4.5% instead of 3.9684% for the 3 times 6 FRA. Recognizing that this rate is higher than what we calculated using the no arbitrage method, you would approach this dealer and borrow at 3.5% for 6 months, invest at 3% for 3 months, and lock in through the dealer the 4.5% investment rate he is offering for the following 3 months. At maturity, your profit per dollar would be 0.00136, calculated exactly as shown in this formula, which you should examine for a second. This may not seem like very much, but please remember that you can implement this very easy trade on very large amounts of money, and that you would be taking very little risk in doing so. Thus, on 100 million notional, for example, your profit would come to $136,309. You may wonder whether the arbitrage only works if the dealer quotes a rate above the correct one and not one that is below. But this is not the case. If, for example, the dealer quotes 3.6% on the FRA, and given that the bid-offer spread is still assumed for now to be 0, you would simply reverse each leg of the trade so you can be taking advantage of a FRA rate that is visibly lower than the 3.9684% that we calculated earlier. You would therefore, as shown in this final paragraph, lend money for 6 months at 3.5 rate, borrow money for 3 months at the 3% rate, and lock in the 3.6% at which you borrow again in 3 months' time for 3 additional months. This time, your profit per dollar at maturity would be 0.00093, or roughly $92,897 for a notional of $100 million. You should check this calculation in your own time. This approach we have illustrated to pricing a forward contract is in fact the same across all asset classes, such as foreign exchange, commodities, and equities, as well as interest rates. but a few subtleties arise with those other asset classes that we discuss in our other modules. We now examine the impact of the bid-offer spread on the FRA arbitrage strategy we just illustrated. Assume the bank is quoting the following rates for 3-month and 6-month interest periods starting January 1, 2009 as before. As you can see from this table, the bank is quoting a FRA rate that appears higher than the correct one we calculated before, while quoting 3 and 6-month interest rates that in each case essentially straddle symmetrically the rates we had seen before. Once again, you try to arbitrage the unusually high FRA rate by implementing, presumably, the first version of the arbitrage we illustrated previously. You borrow for 6 months, lend for 3 months, and lock in the FRA rate to lend again for 3 months in 3 months' time. Now that you need to take account of the bid-offer spread, the outcome of this trade at maturity equals the amount shown in this formula, where you will note we have taken the bid side for the first 3-month period of 2.9%, the bid side of the FRA for the next 3-month period of 4%, and the offer side for your borrowing at 3.6% for 6 months. This amount, unfortunately, comes per dollar to a loss of 0.00067, or if applied with respect to 100 million notional, an aggregate loss of some $66,558. You might ask whether you have simply structured your trade in the wrong direction. So conversely, you might try lending for 6 months, borrowing for 3 months, and locking in for the next 3 months the FRA rate, hoping for a better result. This time the outcome per dollar would be the amount shown in this formula, where we have flipped more or less everything around, and you are now earning the 3.4% bid rate on your investment while paying the 3.1% and 4.02% offer rates for your successive 3-month borrowings. And again, this time you will be left with a loss of 0.00090 per dollar, or 89,597 on the larger notional of 100 million. The answer is, it is not your direction that was wrong with the first trade. It is rather that the apparent error in the FRA rate was simply not large enough to enable you to overcome the cost disadvantages of paying the bid-offer spread on 3 separate instruments. More generally, the error in the bank's quote needs to be large enough to enable you to arbitrage it even after taking account of all these bid-offer spreads. This rarely happens in practice, although it has been known to happen sometimes in emerging markets, where the banks quoting FRAs are not of the highest credit quality, and therefore where any attempt to arbitrage them requires you to assume significant credit risk against them. This leads to a final observation regarding the use of the very term arbitrage. Even the arbitrages we illustrated in this chapter are not entirely risk-free, although they do come as close to risk-free as you are likely to see. Nonetheless, the main residual risks this arbitrage strategy presents are capable of mitigation and ultimately do not interfere much with the economics of the arbitrage. To be specific, these risks are the following. 1. The risk of default by the entity or entities to whom you lend the money. Credit risk, of course. Also, the risk of default by the FRA counterparty if and when the FRA is in your favor at settlement. Another form of credit risk. And finally, the risk that the settlement payment under the FRA, given that it is discounted and paid upfront, cannot in fact be reinvested for the duration of the forward period at a rate at least as high as the one used for the process of the discounting. This is perhaps more in the nature of a basis risk and not really a credit risk. Obviously, you should restrict yourself to credit-worthy entities or demand collateral to mitigate those risks that relate to credit risk.